Hello and welcome to Bricks Videos. This is a channel where we answer all your questions related to property buying. Today's video is on the differences between floating home loan interest rate and fixed home loan interest rate. Buying a house on a home loan takes meticulous thinking and research. It is one of the important financial decisions, and the interest component becomes the centermost aspect of a home loan. So in today's video, let us have a quick look at the types of interest rates, which is floating rate of interest and fixed rate of interest tagged with a home loan. When it comes to fixed rate home loan, the interest rates remain fixed throughout the home loan tenure or a fixed period of time. It means, albeit fluctuations and the market scenario, the interest rate remains unaltered. However, fixed rate home loans can prove to be an expensive affair, as the fixed interest rates are slightly higher than the floating rate of interest. Since the interest rate remains the same throughout the tenure, irrespective of the market conditions, a fixed rate home loan helps a home loan borrower structure the repayment schedule accurately. Usually, fixed rate home loans are at least 1 to 2% higher than the floating rate home loans. And in case if there is any fluctuation in the market scenario and if interest rates reduce, then the borrower would still need to pay the same fixed interest rates. Also, few banks impose prepayment penalties for fixed rate home loans. Hence, it is advised to check if the market trend is conducive to an upswing in interest rates in the future. Also, it is recommended to recognize the best suited considering the financial situation of the home loan borrower and plan accordingly. The floating interest rate, unlike the fixed interest rate, fluctuates according to the market condition. The floating interest rate is subject to changes in the MCLR, which is marginal cost based lending rate, which in turn depends on the interest scenario in the economy. Nevertheless, the fluctuations in the floating interest rates are momentary, and it is usually the tenure of the loan that gets readjusted to account for the changed interest rate. As we discussed already, floating interest rates are less expensive than a fixed interest rate by 1 to 2.5%, and if a borrower is looking for some savings on the interest cost in short term, floating rate home loans can be beneficial. Unlike fixed rate home loans, there is no prepayment penalty for floating rate home loans. The unpredictability and dynamic nature of floating interest rates make budgeting more difficult for the borrower, because not all banks readjust the tenure for the change interest rates, as some banks rather opt to change the repayment structure. Apart from these two, there is also a semi-fixed home loan, which is a combination of fixed and floating rates. In this type of home loan, the interest rates remain fixed for a particular period, after which the interest rate is converted to a floating interest rate. Also, some banks offer an option of converting fixed into floating home loans, where the borrower needs to pay a nominal fee, which is anywhere between 1 to 2% of the outstanding loan amount. In the end, it's again advised to check for all the pros and cons and decide which type fits the bill. This brings us to the end of this video. We hope we have answered your queries relating to this video. If you have any questions, please leave them in the comment section below, and we respond to every comment we receive. Thank you for watching. Don't forget to like and share our videos if you like our work, and don't forget to watch our related videos.